Imagine a scenario where the most powerful governments on Earth pay you handsomely to sit back, take zero risk, and do absolutely nothing. Right now, massive amounts of global capital are flowing directly into government vaults under exactly those terms. This chart shows the interest rates governments are currently guaranteeing. Lend your money to Japan for a 4.2% annual return. The United States is paying 5.2%, and the UK is offering 5.9%. But despite these guaranteed payouts, investors are avoiding the bond auctions. Participation has hit record lows, and as you can see by the baseline plummeting deep into the red, the actual price of these bonds is collapsing. When the US and Iran went to war, global oil prices spiked. Countries around the world suddenly needed massive amounts of cash to buy that expensive oil, and the fastest way to get it was to sell the bonds they were already holding. That massive sell-off creates a mathematical trap. A 5.2% yield cannot help an investor whose initial principal drops by 10% the moment they try to sell the bond. This collapse of risk-free assets marks the opening phase of a pre-designed three-part playbook orchestrated by the US to save its own national debt. Historically, the United States has relied on one primary method to bail out its debt, relying on massive foreign purchases to keep the market afloat. Both the Bank of England and the Bank of Japan are borrowing money within their own struggling economies at painfully high domestic interest rates, just to funnel trillions of dollars directly into US Treasury bonds. The trap closed on them because of timing. Japan and the UK purchased the vast majority of these US bonds around 2020, locking in yields that were hovering between just 1 and 2%. Today, new US bonds are paying over 5%. No investor will buy old bonds from Japan or the UK that only yield 1 or 2%, leaving trillions of dollars in foreign-held assets functionally worthless and unsellable on the open market. With its closest allies now entirely tapped out and holding billions in unmovable paper, the US must move to phase 2 of the playbook to survive. With bonds collapsing and traditional high-dividend stocks losing their appeal, massive institutional funds, like insurance companies, have lost their traditional safe harbors for capital. This displaced capital is flooding straight into US big tech giants like Apple, Microsoft, and Nvidia. Because of their immense liquidity, these companies have become the default holding pen for trillions in orphaned money, creating a massive wave of passive growth. The US government can utilize this swelling bubble for a specific purpose. When the tech market eventually crashes, the resulting panic will flee back into the only remaining asset perceived as a safe haven, US Treasury bonds. That forced, desperate demand for US bonds will artificially drive their prices right back up. As bond prices rise, their interest rates will fall, drastically lowering the US government's cost to borrow money. This artificial surge has turned the tech sector into a pre-designed holding pen, a fattened sheep waiting for the slaughter to rescue the US debt market, mirroring the cycles of 2000 and 2008. In 2025, the global market faced a massive stress test when a sudden threat of international tariffs caused stocks to plummet. This event functioned as a real-world trial to see if fleeing capital would return to the safety of US Treasury bonds. The market's reaction was unexpected. When tech stocks crashed, investors refused to buy US Treasuries, and bond prices plummeted right alongside equities. Investors realized that to save a plunging stock market, the US government would have to print money. That action inherently causes inflation, which devalues the dollar and instantly wipes out any yield earned on a bond. Instead of buying bonds, smart money fled toward physical, non-interest-bearing assets like gold and silver. These are hard assets that cannot be mathematically devalued by a central bank's money printer. Because the market saw through the tech crash trap, the US is backed into a corner. It must execute Play 3, forcing the Federal Reserve to secretly expand its balance sheet and print money to buy its own debt. The world's wealthiest individuals recognize that this money printing phase is inevitable. In response, they are quietly liquidating their tech holdings to prepare. Warren Buffett's defensive strategy involves borrowing massive amounts of nearly free Japanese yen to purchase trading companies that control hard global commodities like coal, iron, and grains. As the dollar and the yen depreciate from aggressive money printing, the global value of Buffett's physical commodities will rise, absorbing the wealth that is lost by the failing currencies. He is joined in this physical asset grab by Bill Gates, who has purchased 270,000 acres of American farmland, and Mark Zuckerberg, who is also constructing massive self-sufficient bunkers in Hawaii. Everyday investors have one major advantage over these billionaires: agility. Because retail investors have less capital to move, they can ride the tech bubble longer and exit at the last moment, provided they operate on logic rather than emotion. Surviving this impending wealth transfer requires abandoning guesswork. You have to adopt a strict system based entirely on risk control, money management, and precise chart signals. We created the SFA Free Stock Investment Masterclass to provide an accessible framework designed to help you navigate this exact pre-designed economic script and protect your hard-earned capital. The macroeconomic tide is already going out. Click the link below to learn the system before you are left paying the bill for the US debt crisis. Thanks for watching Stewardship Finance Academy, and we'll see you in the class.